Is it a way to get into the markets and is it convenient? Yes, but ETFs probably aren't the best way.
So Carley, perhaps you would like to start by talking through the primary key price drivers for crude oil going forward for the rest of 2016.
I actually believe the two biggest price drivers of crude oil going into the end of the year is going to be seasonals and the currency market. And both of those are probably things that nobody expected me to say. Generally, the answers will be OPEC, supply and demand, and all those types of things. And obviously, those factors will come into play. There's no doubt about that. But a lot of people underestimate the impact that seasonals have on the commodity markets and even the impact that currencies have on them. For example, the price of crude oil tends to, seasonals are not an exact science. Some years they work, some years they don't, but more often than not, they do work. And seasonally speaking, crude oil tends to peak out right about now and normally trades weaker through the end of the year and even into early January, February area. Now, keep in mind, markets never go straight up or straight down. So even if that prediction is true, there's going to be a lot of big spikes and rallies in between, usually news-driven. Maybe OPEC says something that's unexpected. The market rallies $5 or $6 a barrel, but that doesn't necessarily mean that seasonals won't eventually take hold. As we all know, crude oil is valued or priced, I should say, in U.S. dollars. And so when the U.S. dollar moves up or down, it has a significant impact on crude oil prices. And with that said, the U.S. dollar tends to also see a little bit of weakness going into the end of the year, which does impact prices.
And you're right with the US dollar and crude oil correlation there, so we'll touch on that in a second. But before we take a look at that, let's talk about the most effective ways for people to participate in the price speculation of crude oil for those market movers and investors that are watching.
Sure. Everybody hears about crude oil on business news stations. They read about it in the Wall Street Journal or on the internet. So a lot of people want to participate in crude, but they're not exactly sure how to do it or how to do it efficiently. Unfortunately, most people tend to navigate to what's comfortable, and that probably means most people have a stock trading account or an investment account that has access to crude oil ETFs. So most people tend to just go with what's easy, and so they trade crude oil ETFs in the U.S. It's the USO is the symbol. However, there's some drawbacks to that. You are going to get some exposure to crude oil pricing with those types of ETFs, but it's not perfect. In fact, it's pretty inefficient. For example, I've seen ETFs and other commodities such as natural gas and some of the others that simply don't follow the underlying commodity as closely as it should. Maybe, sometimes the market will move 10%, but the ETF will only move 2 or 3. So is it a way to get into the markets and is it convenient? Yes, but ETFs probably aren't the best way. I think that the best way to participate in the markets is in the futures market because it's pure price speculation. A lot of people are turned off by the idea of leverage that the futures markets entail, and I totally understand that. But if you do your research and you educate yourself on how to manage leverage and how to reduce it, just because the futures market gives you free leverage doesn't mean you have to use it. If you simply overfund your account, you can reduce the leverage, reduce the account volatility, and put on a relatively tame trade that is extremely efficient. So for those of you that are willing to put in the work to learn about the futures markets, I think that's probably the most efficient way to go about it.
Great, and now taking a look back at the US dollar and crude oil price correlation that you did talk about. So what drives this correlation and how correlated actually is this market?
Correlations are interesting because they change all the time. They go from, they fluctuate with the markets and with the trends, and with a lot of it has to do with algorithmic trading. The computer programmers find some sort of pattern in prices and they write their programs accordingly, and sometimes that exacerbates things. But with that said, the price of oil and the US dollar tend to be negatively correlated. I've seen it as high as 95%, meaning 95% of the time they will move in opposite directions. I've also seen it the exact opposite. So it just kind of it is what it is. But generally speaking, when the U.S. dollar goes down, commodity prices go up and vice versa. At the moment, the price of crude oil and the U.S. dollar are roughly about 60 to 70% negatively correlated, meaning they're moving in the opposite direction most of the time. It's a little bit tricky because sometimes that correlation will dwindle and break, and the market doesn't send out a memo to tell us things are changing, so we just have to kind of be on our toes and be observant. But it is something to keep an eye on as we go into year end. And
it definitely leaves you in a bit of suspense there. Well, thank you so much for taking the time to share your insights today.
Absolutely. It's been a lot of fun. Thanks for having me.
Thank you so much. Well, that's all from myself and Carly, but if you did like this interview, then do like and comment on dugoscopy.tv.